Good morning. On Wednesday, November 5th, 2025, many woke up to surprising financial news. Gold prices were already making big moves as the day began. In early Asian trading, gold jumped sharply. Spot gold climbed nearly a full percent, reaching $3,966.56 per ounce. This sudden surge caught the attention of investors worldwide. The rebound was striking, coming right after a recent decline. Just the day before, gold had fallen to a weekly low. A wave of nervousness or a risk-off mood spread through the markets. When investors get anxious, they often turn to gold as a safe haven. So what exactly is this risk-off mood we've been talking about? It's a term you'll hear a lot from financial experts, and it's a pretty simple concept at its core. Imagine you're planning a picnic. If the weather forecast is sunny and clear, you might feel adventurous and plan a big, elaborate outing far from home. That's like a risk-on environment in the markets, where investors feel confident and are willing to put their money into assets like stocks, which have the potential for high growth, but also carry higher risk. They are optimistic about the future and are willing to take chances for a bigger reward. Now imagine the forecast suddenly changes to cloudy, with a chance of thunderstorms. You would probably change your plans. Instead of that big adventure, you might opt for a simple picnic in your own backyard, close to the safety of your house. This is what happens in a risk-off mood. Investors see storm clouds gathering over the economy. Things like concerning news, poor company earnings, or political instability. Their priority shifts from seeking high returns to protecting the money they already have. They become more cautious and start moving their investments away from those riskier assets and into things they believe are safer and more stable. When investors get nervous and enter that risk-off mode, they start looking for a safe place to park their money. This is where the idea of a safe haven asset comes in. Think of it as a financial lifeboat in a stormy sea. A safe haven asset is an investment that is expected to be reliable and hold its value, or even increase in value, when other parts of the market are performing poorly. People flock to these assets not necessarily to make a huge profit, but to preserve their wealth and protect themselves from losses. It's a defensive move, a strategy for financial self-preservation. For thousands of years, gold has been considered the ultimate safe haven asset. Its appeal is timeless and universal. Unlike paper money or digital stocks, gold is a physical, tangible thing you can hold in your hand. It has a limited supply, as it has to be mined from the earth, which helps it maintain its value. Furthermore, gold doesn't rely on any single government or company for its worth. A stock's value is tied to the performance of a specific business, and a currency's value is tied to the health of a country's economy. Gold, on the other hand, has an intrinsic value that is recognized all over the world. So, what exactly caused this sudden wave of fear to wash over the markets? The trigger came from some of the most powerful and influential voices on Wall Street. The CEOs of two of the world's biggest investment banks, Morgan Stanley and Goldman Sachs, issued some very serious warnings. They publicly expressed concerns that the stock market, particularly in the technology sector, was showing signs of a bubble. This is a term used to describe a situation where the prices of assets, like stocks, rise to levels that are far beyond their actual fundamental value. It's like a balloon being inflated more and more, getting bigger but also more fragile and likely to pop. These high-level warnings were not to be taken lightly. When leaders of institutions like Goldman Sachs and Morgan Stanley speak, the entire financial world listens. They suggested that the incredible rally in stock prices, especially among tech companies, had gone too far, too fast. They pointed to what they called richly valued stocks, meaning the prices were so high, they seemed disconnected from the company's actual earnings or future potential. They warned of a possible sharp equity market drawdown, which is a technical way of saying a sudden and significant drop in stock prices. This kind of talk from such respected figures is a major red flag for investors everywhere. While the immediate trigger for gold's rise was fear in the stock market, there are other powerful forces that are always influencing its price. One of the most important is the U.S. Federal Reserve, often just called the Fed. The Fed is the central bank of the United States, and its decisions on interest rates have a huge impact on the entire economy, including the price of gold. When the Fed raises or lowers interest rates, it's like adjusting a giant control knob for the economy. These adjustments change how attractive it is to borrow, save, and invest money, which in turn affects assets like gold. Here's how it generally works. When the Federal Reserve lowers interest rates, it becomes less rewarding to keep your money in a savings account or to buy government bonds, because they will pay you less interest. This makes an asset like gold, which pays no interest at all, look more attractive in comparison. Lower interest rates can also stimulate the economy, but they sometimes lead to worries about future inflation, which is when money loses its purchasing power. Since gold is known for holding its value during inflationary periods, lower interest rates tend to be good for gold prices. People buy gold as a way to protect their wealth. Another major factor that has a huge impact on the price of gold is the value of the US dollar. The two have a very special and often inverse relationship. Think of them as being on opposite ends of a seesaw. When the value of the US dollar goes up, the price of gold tends to go down, and vice versa. This happens for a couple of key reasons. The first and most direct reason is that gold is priced in US dollars all around the world. No matter where you are, from London to Tokyo, the global benchmark for gold is set in dollars. Because of this, a stronger US dollar automatically makes gold more expensive for anyone holding a different currency. For example, if you are an investor in Europe and you want to buy gold, you first have to convert your euros into dollars. If the dollar becomes stronger, you will need more euros to buy the same amount of dollars, which in turn makes that ounce of gold more costly for you. This higher cost can reduce demand from international buyers, which puts downward pressure on the overall price of gold. A weaker dollar has the opposite effect, making gold cheaper for foreign investors and boosting demand. Beyond the big headlines about Wall Street warnings and Fed decisions, investors also pay very close attention to a steady stream of economic data. These are reports that give us a checkup on the health of the economy. One of the most important of these reports is the jobs report. Information about how many jobs are being created, what the unemployment rate is, and how much wages are growing, tells us a lot about the current economic climate. Strong job growth is usually a sign of a healthy, expanding economy, while weak job numbers can be an early warning sign of a slowdown or even a recession. These economic indicators are crucial because they provide clues about what the Federal Reserve might do next with interest rates. If the job market is very strong and wages are rising quickly, the Fed might worry about the economy overheating and causing too much inflation. In that case, they might be more inclined to raise interest rates to cool things down. As we've discussed, higher interest rates are typically bad for gold prices. On the other hand, if a jobs report comes out and shows that hiring has slowed down significantly, it could signal economic weakness. This might prompt the Fed to lower interest rates to help stimulate growth, which would be a positive for gold. While gold was stealing the spotlight, it's not the only metal investors watch. The metals market is dynamic, and other precious and industrial metals also react to economic shifts. Silver and platinum, for example, saw their prices rise alongside gold. These metals often move in a similar direction to gold, though their stories can be more complex. Silver is sometimes called gold's little brother. It shares gold's safe haven appeal, but also has major industrial uses. Silver is vital in electronics, solar panels, and medical equipment, so its price reflects both safe haven demand and industrial demand. So, after looking at all these different factors, the warnings from Wall Street, the actions of the Federal Reserve, the dance with the dollar, and the economic data, we come back to a simple, powerful truth. Gold's value shines brightest when the future looks darkest. The events of November 5, 2025, were a perfect reminder of this enduring principle. When confidence in more complex financial assets like stocks begins to crumble, people instinctively return to something real, tangible, and historically reliable. Gold is more than just a shiny metal. It's a symbol of security in a world that can often feel very insecure. The reasons for this are deeply rooted in both psychology and history. Gold has been a store of value for millennia, long before stock markets or modern currencies even existed. This long history gives it a level of trust that is hard to replicate. It doesn't depend on the promises of a government or the profits of a corporation. Its value is recognized across cultures and borders. This is why, when people get nervous about the stability of the financial system, whether due to a potential market bubble or other economic threats, gold becomes an essential part of their strategy to protect their wealth from the unknown.